Hello everyone, welcome to the market opening bell for Wednesday, April 29th, your 10-minute guide to the stock market. Hong Kong stocks continue to move lower. The Hang Seng Index opened down 111 points and traded with downward pressure throughout the morning. The decline narrowed to a low of just 28 points at 25,896, but in the afternoon the drop widened again to a low of 316 points at 25,609. The index eventually closed at 25,679, down 245 points or 0.95%. The H-share index closed at 8,644, down 111 points or 1.3%. The Hang Seng Tech Index closed at 4,827, down 112 points or 2.3%. Total market turnover for the day was 262.3 billion. Southbound trading total $110 billion, while net southbound capital inflow reached $14.523 billion. Net buying included tracker fund 4.137 billion. Hang Seng China Enterprises Index ETF 2.64 billion. Xiaomi 1.809 billion. Cambridge Technology 1.224 billion, CNOOC 962 million, and CSOP Hang Seng Tech Index ETF 861 million. Net selling included Alibaba 1.251 billion, Tencent at 1.132 billion, Hua Hong Semiconductor 626 million, SMIC 408 million, and ICBC 106 million. According to statistics, southbound funds have net bought CNOOC for 13 consecutive days, totaling $5.985 billion. Net sold Alibaba for 6 consecutive days, totaling $4.367 billion, and net sold Tencent for 3 consecutive days, totaling $1.918 billion. Technically, the Hang Seng Index has broken below the 20-day moving average at 25,749 points. The next support level is the 250-day moving average at 25,403 points, while the immediate upward resistance stands at the 50-day moving average at 25,887 points. On the mainland, the three major A-share indexes closed softer, with the China export seeing wider losses in the afternoon. The Shanghai Composite closed at 4,078, down 7 points or 0.2%. The Shenzhen Component Index closed at 14,830, down 165 points or 1.1%. The Chinex Index closed at 3,596, down 52 points or 1.4%. Combined turnover in Shanghai and Shenzhen was 2.53 trillion yuan. The renminbi central parity rate against the US dollar was set at 6.8589, down 10 pips from the previous day. The Ministry of Human Resources and Social Security released data showing that 2.99 million new urban jobs were created nationwide in the first quarter. The average urban surveyed unemployment rate stood at 5.3%, indicating that the overall employment situation remained stable. Although first quarter employment figures were slightly below seasonal expectations, there's still ample room to reach the full year target of over 12 million new jobs. Company results announcements. Ningde CATL announced the placement of 62.385 million new H-shares, representing approximately 28.58% of the enlarged H-share capital and 1.36% of total issued shares. The placement price was 628.2 Hong Kong dollars per share, a discount of about 7% to Monday's closing price of $675.5. The net proceeds were approximately 39.11 billion Hong Kong dollars intended for global new energy project construction, zero carbon business layout and R&D investment, replenishment of working capital, and other general corporate purposes. This move aims to accelerate its global zero carbon strategy and support long-term sustainable development. The placement was oversubscribed by more than 150 institutional investors, including hedge funds, sovereign wealth funds, and existing shareholders, demonstrating strong international recognition of its long-term leadership position. The new shares represents only 1.36% of the enlarged total share capital, resulting in relatively mild dilution for existing shareholders. CATL's share price fell 6.9% to close at $629. It has dropped 18% from its record high of $745 set last week. CNOOC released its first quarter results ended March 2026, delivering steady performance with growth in both revenue and profit. Under Chinese accounting standards, revenue reached 116.079 billion yuan, up 8.6% year-on-year. Net profit was 39.144 billion yuan, up 7.1%. Basic earnings per share were 0.82 yuan. Oil and gas net production reached 205.1 million barrels of oil equivalent, up 8.6% year-on-year. Domestic net production was 140 million barrel oil equivalent, up 7%, driven by fields such as Kenli, Ten-2. Overseas net production was 65.1 million BOE, up 12.3%, mainly from projects like Guyana Yellowtail. Average realized oil price was $75.92 per barrel, up 4.5%, while all-in costs remained competitive at $28.41 per barrel. Realized gas price was $7.69 per thousand cubic feet, down 1.2%. Unaudited oil and gas sales revenue was approximately 97 billion yuan, up 9.9%. In exploration and development, the company made 4 new discoveries and successfully appraised 12 oil and gas structures. Sinopec reported its first quarter 2026 results, showing a slight decline in revenue but a significant increase in net profit. This was mainly due to inventory gains from higher crude oil prices and a strong recovery in refining operations. Revenue was 706.6 billion yuan, down 3.9% year-on-year. Net profit attributable to shareholders reached 17.739 billion yuan, up 26.9%. However, net cash flow from operating activities turned negative at 5.558 billion yuan, compared with a positive 8.138 billion yuan in the same period last year, which the market viewed as a notable warning signal. While refining performed strongly, the chemical business continued to face challenges from new capacity releases and narrowing margins. Ping An Insurance announced its first quarter results featuring growth in operating profit but a decline in net profit. Total income was 238.477 billion yuan, down 7.1%. Operating profit rose 7.6% to 40.78 billion yuan. Net profit fell 7.4% to 25.022 billion yuan, with basic earnings per share at 1.43 yuan. Property and casualty insurance recorded premium income of 90.951 billion yuan, up 6.8%, and insurance service income of 84.334 billion yuan, up 3.9%, with the combined ratio improving to 95.8%. New business value for life and health insurance rose 20.8% to 15.574 billion yuan, driven by strong demand for production products and successful channel reforms. Ping An Bank reported operating income of 35.277 billion yuan, up 4.7%, and net profit of 14.523 billion yuan, up 3%. The non-performing loan ratio remains stable at 1.05% as of end March 2026. Looking ahead, the company will continue to advance its dual-wheel strategy of integrated finance plus healthcare and elderly care alongside technology-driven development. BYD reported its first quarter results, recording the largest single quarter profit decline in nearly 6 years. Revenue was 150.2 billion yuan, down 11.8%. Net profit attributable to shareholders fell 55.4% to 4.085 billion yuan. Earnings per share was 0.448 yuan. Excluding non-recurring items, net profit dropped 49.2% to 4.148 billion yuan. The main reasons were intensified price competition and margin erosion. In March, BYD increased discounts to counter rivals such as Xiaomi and Geely, significantly reducing profit per vehicle. The removal of purchase tax subsidies also led to a seventh consecutive month of declining sales in March. On the positive side, R&D expenses rose 38.8% to 8.285 billion yuan. Overseas sales grew over 50% in the quarter, with higher margin overseas models helping to support core operating profit. The company maintained its 2026 overseas sales target of 1.5 million vehicles, requiring over 40% growth. BYD Electronic announced first quarter results that fell significantly short of expectations. Revenue rose 3.5% to 38.183 billion yuan, but net profit plunged 95.5% to 27.83 million yuan. Earnings per share was 0.01 yuan. The company cited foreign exchange losses due to currency fluctuations affecting the parent's attributable profit, as well as changes in product mix that pressured overall gross margin. Android phone assembly demand remained weak. AI-related revenue currently accounts for only about 0.5%, but the company expects AI business revenue to reach 10 billion yuan by 2027, driven by ramp-up in liquid-cooled AI servers and power components. The market is watching for margin recovery from next-generation foldable phones and upgraded components. Bank of China Hong Kong will release its first quarter results today. The quarter-on-quarter drop of 66 basis points in HIBOR offset positive contributions from wealth management, market business, and cost control. Pre-provision operating profit is expected to range between 14.898 billion and 15.765 billion Hong Kong dollars, down 1.3% to 6.7% from the same period in 2025. Investors will focus on the bank's exposure to Hong Kong and mainland commercial real estate, non-performing loan ratios, credit costs, and management's latest guidance on shareholder returns. Hong Kong banks will release their Q1 2026 results from late April to May 5th. Net interest income will be under pressure due to lower HIBOR, but this is expected to be largely offset by strong wealth management and market income, plus good cost discipline. Credit quality and management comments on geopolitical risks will remain key focuses. The new listing today, Sunmi Technology, closed at $93.65 in the grey market trading session yesterday on Philip Mart, representing a 276.7% premium or $68.79 above the listing price. Excluding transaction fees, each bought lot of 100 shares would yield a paper profit of $6,879. Weak OpenAI earnings and rising oil prices weigh on the market, causing all three major U.S. stock indexes to decline. The fear gauge VIX index fell 0.2 points or 1.1% to 17.8. The Nasdaq dropped 223 points or 0.9% to 24,663. Thanks to strong first quarter results from Coca-Cola, the Dow Jones Industrial Average edged down just 25 points or less than 0.1% to close at 49,141. The S&P 500 fell 35 points or 0.5% to 7,138. The Nasdaq Golden Dragon China Index, which tracks Chinese concept stocks, declined 33 points or 0.5% to close at 6,835. Semiconductor stocks weakened, with the VanEck Semiconductor ETF falling 3%, Nvidia down 1.6%, and Broadcom and Oracle both dropping around 4%. Alphabet, Amazon, Meta, and Microsoft are scheduled to report earnings on Wednesday, while Apple will release results on Thursday. Visa announced that adjusted earnings and revenue for its fiscal second quarter ended March both beat expectations, driven by continued growth in credit card spending. Earnings per share came in at $3.31, above the consensus estimate of $3.1. Revenue rose 17% to $11.2 billion, surpassing expectations of $10.75 billion. Coca-Cola reported first quarter net profit rose nearly 18% year-over-year to $3.92 billion. Adjusted earnings per share reached 86 cents, beating the expected 81 cents. Adjusted net sales grew 12% to $12.47 billion, above the forecast of $12.24 billion. Organic revenue, excluding acquisitions, divestitures, and currency effects, increased 10%. North American volume grew 4%. The company now expects full-year EPS growth of 8 to 9%, up from its previous forecast of 7 to 8%, and reiterated its organic revenue growth outlook of 4 to 5%. Starbucks reported fiscal Q2 results ended March 29th that beat expectations on both earnings and revenue, while raising full-year guidance. Non-GAAP EPS rose from $0.41 a year ago to $0.5, ahead of the expected $0.43. Revenue increased 8.8% year-over-year to $9.53 billion, beating the consensus of $9.17 billion. Global comparable sales grew 6.2%, supported by higher transaction volume and average ticket size. U.S. same-store sales rose 7.1%. The company raised its full-year adjusted EPS guidance to $2.25 to $2.45 from $2.15 to $2.4 previously, compared with the market expectation of $2.29. It also lifted its global and U.S. comparable sales growth forecast from at least 3% to at least 5%. Starbucks shares rose 5% in after-hours trading. In other earnings reactions, Spotify fell 12% post-results, while United Parcel Service dropped 4%. On economic data, according to a preliminary survey by the Conference Board, the U.S. Consumer Confidence Index rose 0.6 points to 92.8 in April, despite higher prices caused by Middle East tensions. March's reading was revised upward to 92.2. The Pleasant Situation Index fell 0.3 points to 123.8, while the Expectations Index rose 1.2 points to 72.2. Our stock pick today is China Telecom, stock code 728. China Telecom is transforming from a traditional telecommunications operator into a leading artificial intelligence service provider. Although its first quarter 2026 results were impacted by VAT adjustments and weakness in traditional businesses, leading to a year-on-year decline in net profit of approximately 17.1% to 7.35 billion yuan, its emerging business and cash flow control remain key investment highlights. The group is capitalizing on the new AI plus consumption upgrade trend, accelerating the integration and upgrading of connectivity, terminals, applications, and benefits. It continues to enhance the intelligent supply of products and services for individual and household users. Its core businesses remain stable, with 5G network users reaching 310 million, a penetration rate of 71.3%. Total mobile data traffic grew 17.7% year-on-year, with mobile data usage per user (DOU) reaching 23 gigabytes, up 12.6% year-on-year. Gigabit broadband user penetration stood at approximately 34%, indicating that data value continues to be realized. On the other hand, the group has further deepened its integrated intelligent cloud system, covering computing power, platform, data, models, and applications, comprehensively advancing the AI Plus initiative. It is strengthening internal applications and external empowerment, improving operational quality and efficiency, and supporting the digital and intelligent transformation of the economy and society. Its strategic emerging businesses maintain strong momentum, with 10-year cloud revenue growing 6.8% year-on-year and intelligent revenue surging 39.4%. Leveraging its cloud network integration advantages, the group has secured multiple large AIDC, stands for AI Data Center, contracts worth over 100 million yuan each, effectively driving both existing and new business growth. In the first quarter, the group's net operating cash flow reached 23.2 billion yuan, representing a substantial year-on-year increase of 114.4%, mainly due to strengthened accounts receivable collection and cost control. Total capital expenditure for 2026 is expected to decrease by 9.2% to 73 billion yuan, but the proportion allocated to intelligent fields has increased significantly, showing the company is engaging in precise spending for high-efficiency returns. The group has positioned AI as its core strategy, with intelligent field investment expected to grow 26% against the trend in 2026, of which AIDC investment is projected to rise 28%. At the same time, it's strategically shifting toward token operations. With the anticipated explosion of domestic AI applications, intelligent computing demand is expected to drive long-term growth in industrial digitization businesses. Recommendation: buy at $5.10, target price $5.60, stop loss at $4.85. I do not hold the above stock.